Welcome to Finance Infopedia. So in this video, I will be explaining you about a topic that is what is share market index. If you're reading newspapers or watching television news channels, these two words, that is SENXEX and NIFTY, these are the two commonly used words to explain about the performance of equity market. You might relate these two words, that is NIFTY and sensex, with equity market or buying and selling shares or the movement of share price and all. Still, do you know exactly what is how this equity market index is formed, or how this sensex and NIFTY is formed, how it is how the movement of this index points is counted? Do you know exactly how it works? So in this video, my intention is to explain you in detail how index market or share market index functions, or how it is calculated, and also by understanding equity market index, in the next video I will be able to explain you what is meant by equity index fund. Equity index fund is a type of mutual fund, and I believe that for a layman, instead of going to mutual funds or instead of investing in direct stocks, investing in index fund is the most helpful and the most profitable successful way of creating wealth through equity by participating in equity market. So for you to understand index fund, first you should understand what is share market index. Okay. So with that, let me go to the presentation mode. So before beginning, for those who are very beginners, they should understand what is equity market. So to tell about equity market, what is meant by market? Market is a place where you buy and sell things, right? It's a place where the buyers and sellers come together and will do transactions, right? So in equity market, the same thing. The buyers and sellers and a middleman called as broker will be there. The buyer will say which shares they want to purchase, and the seller and the broker will try to match the buyer's requirement with a seller and will do the assist in doing the transactions. So in equity market, buying and selling of listed companies will happen, or the buying and selling of shares of listed company will happen in equity market. So the exchanges or the market in India, the equity market or the equity exchange in India, commonly used, most famous exchanges in India are Bombay Stock Exchange and National Stock Exchange. If we take the example of US, one example is New York Stock Exchange. So earlier it was all these were physical activities. Now everything is digitalized. Buying and selling, everything happens through trading account digitally, and the certificates that we once we buy a share, the certificate that we held are stored in a digitalized format. Hence, we need to have a demat account, which stands for dematerialized account. So this is just a brief explanation about equity market. Getting to the main topic, what is stock market index? Stock market index, just keep in your mind that stock market index is a tool. It is a tool to measure the performance of equity market. It is a statistical tool that is used to measure the performance of our equity market or any equity market. So how this index is formed? Index is formed by clubbing together, by bringing together group of many stocks based on predefined criteria. So understand that index means there are many index in one exchange. If we take the example of Indian equity market, whether it is a National Stock Exchange, whether it is Bombay Stock Exchange, within National Stock Exchange itself, there are many index. So each index is formed based on different predefined criteria. For example, Nifty 50 from National Stock Exchange or Sensex from Bombay Stock Exchange. These are formed, different index in these exchanges are formed using a different group of shares, and these shares are formed decided or included in each index based on a predefined criteria. So when I say predefined criteria, what is meant by predefined criteria, or what all are the parameters that are included in this predefined criteria? So as I said, stock selection in an index is different for each index. So it is practically, technically not possible for you to explain each and every index and how stocks are selected in each and every index. For you to understand, I will give you one example, and the most commonly used index is, as I said, Nifty 50 and Sensex. So in this case, I will take the example of Nifty 50, and Nifty 50 index is created using free float market capitalization weighted method. So three important words are there here, which I believe you will not be able to understand because it's not a general commonly used words. These three words are free float, market capitalization, and weighted method. So the first one, free float. What is meant by free float? Free float means the shares that with maximum liquidity. Liquidity means maximum number of buying and selling, or maximum number of transactions happening in a particular company's share. Means that company or that share is having maximum liquidity, means that company is having maximum free float. So that is meant by free float. What is market capitalization? Market capitalization is derived by multiplying per share price with total outstanding shares in the market. To give you one example, assume the case of HUL or Hindustan Unilever. This is just an example. So the numbers that I am telling right now is just for an example. It is not exact. HUL assume that the total number of outstanding shares or issued shares are total number of outstanding shares is around 25 crores, and per share price is 10 rupees. So the market capitalization is total outstanding shares into per share price. That means 25 crores into 10 rupees, which comes exactly 250 crores. So the market capitalization is 250 crores. That means if the management is ready to sell the entire company, and if there is a buyer who is ready to pay 250 crore rupees, the end by paying the market capitalization amount, the paying the value of the entire company, which in this example is 250 crores for HUL, by paying that amount, the buyer can purchase the entire company with 100% ownership from the management of HUL. So that is meant by market capitalized. Weighted method is a bit difficult to understand. Still, I will try to explain in as simple as possible. Weighted method means in an index, if there are 50 companies, each company will carry different weightage. Weightage of shares varies depending upon its position in terms of market capitalization. Already I told you what is market capitalization. It is the value of the company, total value of the company in the market by multiplying outstanding shares into per share price. So if in index, if there are 50 companies, if in Nifty 50 index there are 50 companies, assume that 50 companies are there. Every company has a position, has a rank, starting from first rank, second rank, third rank. The ranking of these companies in Nifty 50 is based on its market value or based on the market capitalization. So the first company or the first rank company in Nifty 50, take it as Reliance, will have highest market capitalization. The second company will have lesser market capitalization. Like that, the market capitalization will come down, and the 50th company will have the least market capitalization. Hence, that 50th company will have the 50th rank in terms of position in Nifty 50 index. As the market capitalization is different, as the value of these companies are different, the importance or the weightage given for each company as per the ranking will be different in the Nifty 50 index. The company with highest ranking or the top position will have highest weightage. For example, 11%, 12% weightage will be given for that company. Coming down, the next company will have 10% weightage. This is just an example. Coming down, 9%, 8%, 7.7, 7.6, 7.5, like that. Once you reach the 50th company, the weightage for that 50th company will be maybe, for example, 0.3% or something. So when this weightage put together, summed up together, you will get 100%. Examples of index in India: Nifty 50, which is the largest 50 market capitalized and traded stocks in NSE. SENXEX is the largest 30 market capitalized and traded stock in BSE. The Nifty Next 50 is the 51st to 100 largest market capitalized companies traded in National Stock Exchange. Bank Nifty is a sectoral index comprised only of banking stocks, which is again traded in NSE. You understood something about index, equity market index right now. Still, to show you the companies that are listed in each index, I will give you 3 examples, starting with Nifty 50. In Nifty 50, see, this is the website of National Stock Exchange. You can see 50 companies. Dasim, Apollo Hospital, Asian Paints, Divis Lab, Dr. Reddy, Britannia. Like this, you can see the order in this, don't get confused, the order given in this is not based on the market capitalization. The order given in this thing, I believe, is based on the change in the market price of last traded day. But just try to understand 50 companies will be there, and in this case the highest largest market capitalized 50 companies in India right now are these 50 companies. Again, if you take the example of Sensex 30, these are the first 30 companies based on the market capitalization in India. So the first, the entire 30 companies in Sensex, and the first 30 companies in Nifty 50 in Nifty 50 index will be the same. Okay, because that largest market capitalized 30 companies in India are the same. Hence, the entire Sensex 30 companies will be same, will be as same as the first 30 companies in the Nifty 50. Again, to give you one more example, Nifty next 50. Okay, so these are the 51st to 100 position. These stocks are included in a Nifty next 50 index. So these are the list of companies that comes under Nifty next 50. Okay. Moving on to the next slide, again to give you some examples of index in US, we have S&P 500, Dow Jones Industrial Average, Nasdaq Composite. So these are the examples of index in US. So when you hear these terms, hear these terms, just think that these are index just like National Stock Exchange, NSEs, Nifty 50, Nifty Next 50, and Sensex, or from Bombay Stock Exchange. Now, again, to just explain you in detail about a weighted average method, which I already briefed you, still to get much more clarity. The common used averaging method in index is weighted averaging method. Weighted averaging method means more weightage is given to the first stock in index compared to the last stock in index, because the first stock in index will have more market value comparing to the last stock. Hence, more weightage is given for the first stock. This helps in cancelling out the impact of movement of one stock in the index. Weightage of first stock or the highest marketized capitalized stock in the index will be higher compared to one with the lower market capitalization, which I already explained you. To give you an example, a small change in the price of first stock in index will seriously affect the Nifty or Sensex value, whereas change in price in the lower stock in the index won't make much difference in value. I will give you one example. See, this is the list of Nifty 50 stock in 2021. Now, the highest market capitalized or the rank, first rank position in Nifty 50 at that time was for HDFC Bank, and the second rank was for Reliance, third rank for Housing Development Finance Corporation, Infosys, then comes Infosys, ICICI Bank. Like that, if we come down, the fourth position is Hindalco, 50th position is GAIL India. So, HDFC Bank, as it holds the first rank in 2021, the weightage given at that time for HDFC Bank was 11.21. For second position, 11.17. For third position, 7.23. Like that, if we take the 30th position for company Divis Laboratories, it had 8.82% weightage. Coming to the last company, that is 50th rank one in Nifty 50, GAIL India Limited, it had 0.34%. So if a 10% movement happens in HDFC Bank, the weightage of Nifty, the movement of Nifty 50 will be higher, because the weightage given for HDFC Bank or importance given for HDFC Bank in Nifty 50 is 11.21. But the same change, that is 10% movement, happens in GAIL India. If it happens, it won't make that much difference in Nifty 50 index, because as the change happened in Nifty 50 when HDFC Bank moved, because the weightage given for GAIL India is just 3.34 comparing to 11.21% weightage given for HDFC Bank. In other way, the weightage given is almost 33 times more comparing to GAIL India, roughly. So what will happen is that if a 1% movement happen in GAIL India share price, whatever changes movement happen in Nifty 50, It's 33 times movement you can experience in Nifty 50 if 1% movement happens in HDFC Bank, because 33 times more weightage is given for HDFC Bank comparing to GAIL India. So I hope weighted average method explanation is clear for you. Again, classification wise, if we take the index in India, exchange based, Bombay Stock Exchange, it includes only companies works in auto industries. We have bank index, which comprised of banking stocks, FMCG index that comprised of FMCG products like Britannia, Jewel. Then team based index are the companies that is giving good dividend. Based on that, Nifty dividend opportunity 50 index is there. Companies with a low volatility, based on that we have Nifty 100 low volatility index is there. To show you the list of entire indices that comes under NSE, you can go to the website of NSE and you can see, go to this page. We have broad market indices, sectoral indices. These are some of the examples. Strategy indices, thematic indices, like this. Many classifications are there for indices, both in NSE and in BSE. Why stock movement of stock market index happens? Well, the movement of an index depends upon the buying and selling of stocks included in the index, right? In Nifty 50 companies are there. So if any of these companies moves based on its weightage, proportionate movement will happen in that particular stock market index. For example, if sellers are more than buyers for bank stocks due to some macro issues in Indian banking system, the bank Nifty index will go down. If RBI is putting a new rule, new guideline which will affect the profitability of banking companies, definitely the share price of the sellers will be more for banking stocks, because of which bank index will come down, right? The same way, also if a stock with heavy weightage in an index is moving up because of sudden positive news in the market, then that particular index also will move up. Just in the case of Nifty 50 in 2021, if Reliance was having the first rank position, if Reliance is moving up 20% at that time, proportionately good movement will you can experience in Nifty 50, because the weightage for Reliance was high at that time. So in simple terms, movement of an index depends upon the movement of stocks included in that index and its weightage in the index. Then sometimes you experience very aggressive up movement and down movement. Aggressiveness will be very high when the market crashed down, when comparing with the market moves up. If the market moves up 20-30%, it will take some months, some time, even during an aggressive period. But during sometimes when the market crashes, you can experience market crash of 10%, 20%, even up to 30%, just in weeks to 1 month time period. To give you some examples, aggressive market movement you might have seen during 2008 recession, to the 2000.com bubble, then recently experienced March 2020 market crash of 30-35% in a period of 1 month's time due to COVID pandemic. Some of the uses of stock market index. The purpose of stock market index is to capture the performance of the overall market. As I said, when Nifty 50 moved up 10% in the last 1 month, if we say, or today, only today Nifty 50 moved 10%. When we are saying, that means the economy, the value or the perception of the market towards the economy itself is moving. It moved down 10%. We can assume in that way. To understand the mode and sentiments in the equity market and Indian economy, we can take a stock market index. To understand the performance of government, if Modi government was ruling our country for the last 10 years, if we see the performance of equity market or the equity market index, Nifty 50 or SENXEX, if we take last 10 years, whatever the growth we are seeing in the index, if it is a very good growth, we can say that the government is doing quite well. To understand the performance of a particular sector, if we want to see how the banking sector is performing, we can see a banking index that comes under Nifty. The other use is to benchmark the performance of other investment option against equity. If one person invested in fixed deposit, the other person invested in real estate, and the third person invested in equity market, how can you compare the performance of these three investment options? You can compare that with the performance of stock market index of last 10 years. If stock market index growth experienced 10% in or 15% in last 10 years, see whether your FT returns you got 15% or your real estate growth investment you got 15%. If you haven't, then you can say that equity market performed well comparing to the other two options in the last 10 years. Again, you can benchmark the performance of mutual fund and the fund managers with stock market index. If the index delivered 15% return and the mutual fund or the fund manager gave only 10% return in last 10 years, you can say the mutual fund was underperforming comparing to the equity market index or equity market. Again, you can use stock market index for passive investment. How this is very important. About this, I will be making a video. The next video will be based on this. Based on stock market index, mutual fund create index funds. Index fund is a type of mutual fund where the fund manager invest only in those stocks that comes under Nifty 50 or Sensex. So when Sensex moves up 10%, the index fund also will move up 10%, about which I will explain you in the coming video. Also, another use of stock market index is it can be used to track the historical performance and trend of the market for a particular period, for say last 10 years or 20 years or so. This is the pictorial representation of the historical performance of BSE Sensex. The base year of Sensex started in 1979. Base value was 100. So it started from here and the base value was 100, and it went like this, in between some crashes, then some boom run, then crashes, crash, boom run, then a deep crash in the year 2020, then again a big bull run, not boom run, sorry, bull run. Then last 6 months it is coming down like this. So from 100 it started here, and now the Sensex point is 54,892. The same thing if we take National Stock Exchange, NSE's Nifty, the historical performance started, the base year is 1995, base value was 1000. It started from here with base value 1000. It went up, came down in between, went up, then again came down, and again a bull run, sudden bull run for the last 1 year after COVID crash. Then it is coming down a little bit in the last 6, 7, 8 months or so. And from 1000, the point of T when I'm recording this video is 16,356. Moving to the next slide, if you compare these two pictorial representations or this trend line of Nifty 50 and Sensex, can you see any similarity? See, Nifty and Sensex move in tandem. Why? Because the first 30 stocks in Nifty and the entire 30 stocks in Sensex are same, and the 31st to 50th stock in Nifty, its weightage is very less comparing to the first 30 stocks. Hence, whenever Nifty first 30 stocks moves, the same stock moves in the same manner in Sensex also, because as I said, the entire 30 stocks in Sensex and the first 30 stocks in Nifty 50 are literally same and having better weightage comparing to the 31st to 50th stock in Nifty 50. Hence, if you see 2008 market crash, here also 2008 market crash, then if you see 2010, if you see, not 2010, 2020, if you see the market crash, whatever you experienced here, the same you might have experienced in Sensex also. Then a bull run for more than 1 year, bull run for more than 1 year, and the last 6, 7, 8 months also we are experiencing a downward movement both in Sensex and Nifty 50. So almost same movement you can experience in Nifty 50 and Sensex due to these reasons. One thing I want to explain here before closing this presentation is, whatever companies are listed in Nifty 50 right now, it is not always necessary that these companies are the same as those that were listed 10 years ago or 20 years ago. It is not necessary that the companies that are listed in Nifty 50 right now will be same as those that will be listed in coming years. It will be keep on changing, and how it will be changed I already told you Nifty 50 is mainly listed based on the market capitalization or value of the company. The first Nifty 50 comprised of the highest 50 ranked or valued companies in National Stock Exchange. So when the share price changes proportionately, the market value or the market capitalization of each company also will change, right? So assume that Reliance is having the highest position, rank 1 in Nifty 50 right now. Just assume that. I don't know exactly which one is having the first rank right now. If Nifty 50 in Nifty 50 Reliance is having the first rank, if if the share price of Nifty 50, if Reliance comes down 50 percentage, definitely the market value of Reliance will come down 50 percentage, right? If that happens, then it will lose its first position. It will lose its first position and will come down and might get the 10th rank or the 20th rank in Nifty 50. Even if the market capitalization comes down drastically, sometimes Reliance will go out of Nifty 50. If Reliance is not getting even the 50th rank, then Reliance will come out of Nifty 50, right? So what will happen? Who will take the first position instead of Reliance? Whoever is having the second rank will take the first position. Like that, there will be an readjustment in the ranking of the companies in Nifty 50. So a company that was not formed 20 years ago, got formed 15 years ago, got listed 10 years ago in a national stock exchange, started doing well. The share price went up like anything, and its market capitalization reached such a level that it will get into Nifty 50 and will take the position of 45th rank in Nifty 50. And again, it will go up, the share price will go up of that particular company and can end up in taking the first rank of Nifty 50. So based on the market capitalization, the position of Nifty 50 will go up and down. The market capitalization goes down like anything, the company will lose its position itself in Nifty 50, and a company that was having the 150th or 200th, or a company that was not even formed at a particular point of time will get listed and will start doing well, and it will get a good market capitalization and will get into Nifty 50 index. So the position will be changing. Stocks that are included in Nifty 50 will be changing. Were listed in Nifty 50 10 years ago will be different from those were listed 20 years ago, and it will be different from what it is right now in the coming years also. So this thing just keep in mind. Okay. So yeah, with this, I'm done with my presentation. Thanks for watching. If you have any comments, any suggestions, please put that in the comment box. Please like my video if you liked it. Share with your friends and relatives who are interested in learning about equity. And also request everyone to subscribe to my channel, that is Finance Infopedia. So thank you everyone for watching this video. Thank you.